Hello, this is Chuck Carnavan. I'm the Chuck in the Markets Up Chuck. And today's blog talks about the importance of earnings and how, what a great predictor they are, and how you can just look at a company's long-term earnings history and instantly, know so much about the company just by reviewing their earnings record. So I'm going to go through a series of companies here, and here's what I want you to do. I'm going to be using 15-year charts. I want you simply to look at earnings. I want you to look over at what the earnings growth has been. Anytime you see the chart blue, that'll represent there's no earnings growth. And when the chart's green, there will be earnings growth. But I want you just to look at each of these companies. I'm not going to talk about any of them. I just want you to look at their earnings and get a perspective of what the picture actually tells you. So the first one was Foster Wheeler. Here's a company that has extremely erratic earnings. You can see that there's been no consistency here. What does that tell you about the company? How do you feel when you look at that earnings record of that company? Here's another one, Rockwell. Look at the earnings here. What's it tell you about what's going on with the operating results of this company? How well are they achieving, earnings growth on their shareholders' behalf? H.J. Heinz, now we have a green chart for the first time. I want you to notice we have a 4.4% growth rate. The scales in all these charts will be different, but what's this tell you about Heinz? Is it it's not very consistent. It's moderately growth. That's about how fast the stock market has grown, by the way. About earnings about 4.5 to 5% over the last 15-year period. But there you have a 4.5% grower. Here's Hormel, which would be a company, certainly a competitor in their industry. You can see a 7.3% growth rate, more consistent. How do you feel when you look at Hormel's 15-year record compared to some of the other names that we've looked at here? Then, the next picture I want to show is Cisco, and you see a much, different scale here, much higher growth rate, 21.6%. This goes through the irrational exuberant period. I want you to notice a big drop-off after all the dot-coms went out of business, and then a reacceleration. But there you can tell an awful lot about this company just by looking at their earnings record here. Then here's Express Scripts. This will be the best company I show you, at least in my opinion, the best picture I show you. I want you to notice you've got extremely consistent earnings growth year after year after year at an unbelievable rate of 33.3%. And then the last example I'm going to be showing in this series, I'm going to show Dun & Bradstreet. I'm going to use it to summarize. I want you to notice in the first half of this chart or so, or for at least the first 6 years, the company's earnings have been very erratic. And I do want you to see that they're, over the last 9 years or so, almost the last decade, the company's really turned itself around. So there you have it, looking at these companies just from the perspective of earnings. And again, I want you to ask yourself, what was your initial impression of each of those companies as you looked only at their earnings? Once you've accomplished that, and I want to bring stock price in, and I want you to notice that these are monthly closing stock prices over the last 15 years. I want you to notice how the stock price correlates and follows earnings. Here's a case of a company that generated no earnings, and I talk about buy and hold at the end of the blog today. And here's a company you clearly don't want to buy and hold. You started out 15 years ago with a $290 stock, and you'd ended with a $24.97 stock. $100,000 in this company would have shrunk all the way to $8,000, losing a compounded 15.9%, and it's earnings that determined the shareholder returns, clearly in this example. The next example I showed was, the Kaluki and Safa. Again, you see very erratic earnings. You see the stock price reacting to those earnings. You see a lot of short-term volatility here, but clearly in the long run, the stock price follows the earnings growth. You again have a company that was, as a buy and hold, would have been a very lousy investment, generating a loss on your capital of 0.6% a year compounded. So, obviously earnings, again, the clear determinant of what happens to shareholder returns. Rockwell Automation, earnings growth a little bit of earnings growth and collapsing earnings growth, collapsing earnings. At the end balance, there was no growth in the company. Shareholders, again, lost money at the tune of about 0.8% a year compounded, where they could have bought the stock market and earned just about 5%. As I mentioned, when I first went through this, you have a company like H.J. Heinz, and this is where valuation comes in. This company's been a 4.4% grower. It historically trades at around 15 times earnings because of the quality of the company. And by the way, it does pay a dividend, although I'm not including dividends in this at all. I'm just looking at how earnings determine the market price of the company. That's the whole point of today's blog. I talked yesterday about valuation. I'm a little bit over the 15 times earnings starting out, and I ended at 12.3 or just under the price earnings ratio coming down. So I would expect this to be something less than 4.4%, and I end up with a 2.6% rate of return in H.J. Heinz. But again, a very strong correlation to the earnings growth of the company. On the other hand, if I look at Hormel, which which has been a more consistent 7% grower. You know, it has a much more consistent earnings record. It's grown at 7%. It's kind of started in value, kind of ended in value, and therefore, as you would expect, this company generated about a 7% rate of return, better than the market, but very consistent with its long-term earnings growth. Earnings determine market price and shareholder returns over the long run. Then, you know, I showed you an example of Cisco, which was a much faster grower. I thought this picture was interesting because I've shown pictures like this before. This is the irrational exuberant period, and this clearly illustrates how in the short run emotions can take over and you know, make just insane you know, valuations. You saw that in the irrational exuberant period. There was no possible way. When Cisco was trading at $77 a share, it was really only worth, in the best case, around $9 or $10 a share. And of course, I want you to notice the price fell to that. But then we had this nice growth again. It's currently undervalued. I think the market's, as I said many times, misappraising stocks today on the downside. But the bottom line is you had about a 21.5% growth rate. You end up with about, because of undervaluation, a 17.1% rate of return to shareholders. Again, this case much better than the stock market, but very consistent and in correlation to the earnings achievement that the company was actually able to achieve. Here's Express Scripts, the company with the, you know, I mentioned is my favorite of the group, very consistent earnings growth. You could just look at this company and say, wow, what a powerful, you know, franchise business it has been. You look at a 33.3% growth rate, and even though the stock is undervalued today, and you know, as it's been before, you can see how every time it was undervalued, the market brought it back up to a more normal price-earnings ratio, which has been about 25 to 30 times earnings. The stock still generated over a 25.7%, almost a 26% compounded rate of return, correlated to their earnings, again explained by the undervaluation. Earnings are the driver of returns over long periods of time, and this is clearly a company that you do want to buy and hold. And for some of you, Hormel might have been a company you would want to buy and hold, where some of the others clearly were not companies that made any sense, you know, to be a buyer and holder of. Now, when I look at Dun & Bradstreet here, I want you to notice in the beginning I had this, you know, very poor earnings record, the stock price collapsed, then we had a nice rise and a nice rally, but when it was all said and done, we still ended up with no growth. So over this 15-year period, I end up losing a compounded 2% a year, or you know, just under 25% of my money. 100,000 grew to 74,000 compared to the stock market. But then I had this turnaround in earnings, and what I think is important here, and kind of to summarize the whole point of my blog, is that during this last 9-year period, when the company's earnings turned around, you see a 16.1% growth rate. You see a 14.9% rate of return to shareholders over the last 9 years. That's much better. This is during a period where the market actually lost, you know, over 30% of its market value. It had a minus 4.4% compounded. It wasn't the stock market. It wasn't the economy. Clearly, this is Dun & Bradstreet kind of getting their mojo correct. You know, their earnings growth, the company really started running a much better business here. A lot of things change. You can research what that, you know, turns out to be. But the reality of it is very excellent returns, you know, based on the fact that the company turned itself around and shareholders were rewarded as a result. In the long run, earnings determine market price, and earnings drive market price. And by the way, when you're looking at you know, any company, and that's why I think this fundamental research analyzer tool is so valuable. By simply looking at the company, you know, without knowing anything else about the company, anything about its business or anything else, you can right away look at the company and determine how well it's been run. You know, when you stop at a company like Express Scripts, you know, earnings growth year after year and the stock price following that, it just tells you volumes of what, you know, what I consider to be the essential fundamentals at a glance instantaneously. I hope this helped give you a perspective. I could show you hundreds and hundreds of examples. This is common sense, but it's something that is often overlooked. People don't recognize how important, you know, earnings are. One company that was just recently in the news and that people like to talk about and think about, and I find are shocked when they actually see the results, would be Sony Corporation. If you look at this company over the last 15 years, you know, the last couple of years it's lost money. In fact, there was a headline in, I think it was the Wall Street Journal or one of the major news publications, it was the first time that they had shown losses in 15 years, and that, you know, everyone thinks of Sony as being such a great, you know, company. It is a pretty good company, and its earnings record and growth, the number actually looks pretty good when you look at it here, because we had a nice surge in earnings in 2007, which is the last that this is reporting on. But the reality of it is you will lost money owning this company, because once again, earnings are the ultimate driver of market price. This is Chuck Carville. I hope you enjoyed today's blog, and I look forward to talking to you again tomorrow. Thanks for listening.